There are two categories we are monitoring for thinking about how the municipal bond market might be impacted by the election outcome. One is technicals, changes in supply and demand, and two are fundamentals, changes in credit quality. Speaking to technicals, tax reform falls in this particular category. Many of the individual tax items from the Tax Cuts and Jobs Act of 2017 will expire at the end of 2025. It's our expectation that President-elect Trump and Congress will roll over many of these provisions. The road could get rocky, however, if President-elect Trump attempts to introduce some of the more novel tax ideas that he floated during the campaign, especially if these ideas have the potential to increase the federal deficit. A question we often get asked by investors is whether or not the exclusion of municipal bond interest from adjusted gross income could be impacted in some way. While this is always front and center as a concern when tax reform is discussed, it's not our expectation, and we view this as a remote risk. It helps to remember that many members of Congress served at the local level. They therefore have a firm understanding of how vital a role municipal bonds play in financing, building, and maintaining infrastructure in the United States. If, however, the exemption were impacted, we believe that this would actually increase the value for the existing stock of bonds outstanding. Switching to fundamentals, one area of focus is not-for-profit healthcare. It's very possible that President-elect Trump and Congress could enact policies that could potentially reduce Medicaid funding, workforce requirements for participation in Medicaid, cuts to supplemental funding. All of that could potentially harm cash flow for the sector. And for that reason, we have an up-in-quality bias for not-for-profit healthcare. We're also focused on immigration reform. It's very possible immigration reform could potentially lower levels of enrollment for higher education, K-12, and charter schools. In addition, immigration policies could reduce the level of labor available to support municipal projects that are currently under construction. Delays may exhaust pre-funded reserves, resulting in higher forbearance agreements. Tariffs could potentially lead to inflationary impacts in our market. That could impact a variety of different sectors, some positive, some negative. Toll roads, multifamily housing, a lot of those rents and a lot of those toll road rates are indexed to inflation. So it's possible that higher inflation, even if it's a one-time shock, could actually improve cash flow for some of those sectors. The MSA tobacco market is another area that's indexed to inflation, and higher inflation could potentially improve the cash flows in that particular sector. Municipal bond investors should expect 2025 to be a noisy year. There may be pockets of unexpected volatility, but the asset class is on strong footing. It's a resilient asset class, and I believe it can withstand anything that 2025 throws its way.